Welcome to the Capital News. I am your host, Alex Karitis. Thank you so much for joining me today, March 15th, 2019. The Ides of March. Beware the Ides of March, as they say. So let's get into some of the economic news and see if there was any disconcerting news for the Ides of March. The S&P was up 14 points. The Dow was up 139. The Nasdaq up 57. And the Russell 2000, the small cap index, was up 4 points for the day. All of these averages were, I don't want to say well off their daily highs, but they closed lower than what they were earlier in the day. So I don't know if we're going to start seeing that trend or not. Obviously, the more recent trend is you have a rally at the end of the day. Are we now going to start seeing a sell-off at the end of the day? I don't know. One day does not make a trend, but it's something that I like to pay attention to because we are living in the financial world of Oz. Oil remains above $58 a barrel. Gold remains slightly above $1,300 an ounce. In the silver market, settled at $15.29 an ounce. The 10-year Treasury, well, get this, ladies and gentlemen, I told you we got to start paying attention to these bond yields, and there was some more buying, which pushed down the yield, and we now sit at 2.59% on the 10-year Treasury. So I think this is something that we have to start paying attention to, and I'm going to discuss why a little bit further in a moment. And then we have to look at the VIX too. I like to bring in the VIX every once in a while, the volatility index, just to see on a daily basis if there's been a lot of movement. And today it was to the downside. It declined 4.5 percentage points, and it now sits at $12.88. But some of the other economic news real quickly that I want to touch on, because again, we continue to get more and more information, not only out of the U.S., but out of other countries. And let's take a quick look at some of the data that's coming out of China. So China's industrial production rose by 5.3% year over year in January through February of 2019. This is the slowest pace since early 2002. So we got to go back 17 years. This followed a 5.7% gain in the prior period and missing market expectations of 5.5%. Output grew at a softer pace for both mining and utilities, while manufacturing production growth was little changed. So here we have it. We have further evidence that China is slowing down, hitting numbers that they haven't seen in 17 years. And what do the markets do? Well, the Asian markets, they went up. The U.S. markets, I just told you, they went up. There is no such thing as bad news anymore. I thought that we were starting to get in a place not too long ago where bad news was bad news and good news was good news. Now we're back to a place where bad news is good news, or it's just completely ignored. I don't know what else to say, because the markets just shrug it off. Yeah, we knew that was going to happen. But then all the good news, even though we're supposedly in this economic miracle, the best economy ever, I don't know how good news can be surprising if everybody believes that. And when there is some snippet of good news or glimmer of hope somewhere, then the markets just rally. I mean, this is just completely disconnected from the reality that we live in. So the ability to forecast or to even really provide proper insight on the day-to-day movements is a fool's errand. So again, we have to focus on this longer arc of what's actually taking place, and I'm going to get into that too. But just some more headlines real quick, just so you understand what's going on around the rest of the world. So we have Malaysia retail sales rise the least in 4 months, so that's not good news. But there's some mixed news, because also in Malaysia, industrial output was above estimates. Okay, so that's at least good. That's a little mixed for the Malaysians. Then you have Singapore. Q4 jobless rate was confirmed at a 1.5-year high. So that's not good. So there's mixed bags, but if you take it in aggregate, most of this is not good information. Whether you're looking in Asia, China specifically, or if you're looking in Europe with the Italians in a technical recession, the Germans just by the skin of their teeth avoided one last quarter. But, with everything that's going on with the Brexit, with the trade war that continues, with the terror attacks in New Zealand, with the threat the potential threat, I guess I should say, of nuclear war or it going to that with the Indians and the Pakistanis. Thank God that seems to be de-escalating. So that's a good thing. There's just so many things that could happen. There are so many wild cards, it's not even funny. Not to mention the 30 risks for the markets in 2019 that we talk about constantly here that are still very much alive and well. But then we have some other news on our front, the U.S. front, and from the U.S. Commerce Department, there was a report that showed sales of new single-family homes fell more than expected in January, suggesting that housing market weakness persisted early in the first quarter. We know this. You pay attention to this podcast, you know this. We're not surprised by this. What I am surprised to see in this article, or should I say, rather, not see in this article, is the fact that they're not blaming this on the temporary government shutdown. Now, I'm sure if I had stumbled upon another article or another source that they would have blamed the partial government shutdown. But we're into March now. We're already halfway through March. So how much longer they're going to be able to lean on that as a crutch and as an excuse, I don't think they're going to get much more juice out of that fruit. I just don't think that that's going to take place. Now, I want to also touch on the conversation that we had yesterday because it's very important for me to stress this to you guys because to me it's important. And I could be wrong. I always say that. I could always be wrong. But in regards to the corporate bond market, I don't know if this is going to be the catalyst, the final straw that broke the camel's back, but this is most definitely a domino in this long row of dominoes. Again, is this the first one that sets it all off? Or is this just going to be one that tumbles when some other catalyst starts this whole thing off? I don't know. But I do know that this is a big problem. And I just want to go into a little bit further detail with you. So to refresh your memory from yesterday, we have a corporate bond market that has doubled since the Great Recession. So we're talking high $2 trillion, low $3 trillion range to now above $6 trillion. So we've more than doubled in a decade. Okay, so this is in thanks to all of the funny money. And you have to understand, again, this is just the corporate bond market. This is not loans from banks. This is not leveraged loans, which is a loan to pay a loan. And that's a huge, that's a huge barrel of dynamite ready to go too. This is just the corporate bond market. Now, as I was saying yesterday, you have corporate bonds, like so many other financial instruments, that are rated by the ratings agencies, primarily S&P, Standard & Poor's, Fitch, and Moody's. Okay? We understand this. What becomes disconcerting to me is you have to understand the history from only a decade ago. And that history was that you have a concern, a legitimate concern, that the ratings agencies are rubber stamping a lot of these corporate bonds at a rating higher than they really should be. This is what they did with subprime mortgages, mortgage-backed securities, and the whole lot of them. They did this. They stamped these things AAA, AA, basically the gold standard of a rating that they could give out, because Goldman Sachs, JP Morgan, all the major banks who were creating these financial instruments they pay the ratings agencies. So there's a conflict of interest right off the bat. Okay? Right off the bat. These banks were looking for the gold standard. They were looking for AAA. And lo and behold, S&P, Moody's, Fitch, boom, they stamped them AAA. But they were junk. The banks knew they were junk. The ratings agencies, if they even really looked at them, they knew they were junk. Or otherwise they were just rubber stamping them and collecting money. I mean, that could have been the game too. So that did hit their reputation a little bit. But of course, the memory span in this country is, that of a goldfish. So a lot of people don't remember this, but I do. And now you do too. So we have to be aware of this. Now, when you have the bond market, you have AAA, you have single A, double A, you have triple B, and then you get down lower, and now you're in speculative or junk status. Okay, junk. That's what it's called. All right. So now I'm concerned that this same game is being played. You can call me cynical. I'm fine with that. But this is how these people make their money. Now, in order to sort of save face a little bit and say, look, you know what, we got caught up in it a decade ago. You made money, we made money. Nobody went to jail, of course. Let's not be too stupid and careless and reckless this time. We're not going to stamp a lot of this stuff AAA, AA, single A, but we're happy to stamp it triple B. I can totally see this being the case. Why triple B? Because triple B is just a notch or two above junk. Okay? So they're sort of covering themselves, they're collecting a paycheck, and it allows a whole bunch of funds to buy these bonds because they're rated triple B. They are considered investment grade. So by these mutual funds and pension funds and whatever, by their own charter, they can only purchase investment grade bonds. Okay? So now they can make a market. These banks and financial institutions can sell these bonds out there. These companies can sell these bonds, and they have a market for them. All right? Now, here's the problem. How many of them actually are triple B? Get what I'm saying? How many of them might actually be, if you look under the hood, if you actually do some financial analysis on these guys, how many of them are actually triple B? How many of them, if you actually did some fundamental analysis, looked under the hood, should be junk? Now, that's a problem because, like I just said, a lot of funds can only own investment-grade bonds. If and when a recession or an economic slowdown occurs, and it's just a question of when, it's going to happen. I mean, recessions, depressions, they have not been outlawed, so it's just a matter of time. We're already at the really far end of a 10-year bull market. We're at the long end of a business cycle, of a debt cycle. So how much further can we go? In the midst of that, we're running trillion-dollar deficits. And according to the president's budget, we're going to be running trillion-dollar deficits for the foreseeable future. And that's according to the man, the president, who says this is the best economy in the world ever. Ever. Hyperbole, exaggeration, not true, you know this. But you don't have that type of scenario, a great economy, in trillion-dollar budgets. Okay? So this all ties together because it's all debt. And this is the point of why this thing is going to unravel, and it will be nasty. I don't care if it's quick. You rip the Band-Aid off, it's going to be painful, it's going to hurt, or it could be prolonged for a long time. I'm talking a decade or two. And it's possible that it's both. But there is no way we are going to skate past this. You cannot defy the laws of economics forever. You just can't. The piper needs paid. That's what debt is. So we have a situation where we have a global economy that is slowing down. We have data after data that shows that the U.S. economy is slowing down. Okay? That's just a fact. That's just what it is. That then means you would think that these companies are not going to be able to make as much money. Okay? If they cannot make as much money, then wouldn't one reason that it's going to be difficult to pay these bonds that are coming due in 2019? That's when a lot of this starts. The investment grade, there's $700 billion of investment grade bonds that are coming due this year, 2019. Okay? They issued 10-year bonds because, remember, at the end of the beginning of, 08-09 crisis, you have the Federal Reserve step up and say free money for everybody. Well, not you and me, but, for major corporations, for the banks, for the government. So 10 years ago, they said, these guys are giving us free money. We're going to take it. We need it. So they took it. And now the piper wants paid. It's coming due. So you got $700 billion in investment-grade bonds coming due throughout 2019, and then you start to get a big wave of the junk market that is coming due, in addition to the investment-grade bonds, for the next few years, really out to 2023. So for the next 4 years, we are going to see over nearly $4 trillion worth of corporate bonds coming due. And again, that does not include loans and leveraged loans. This is just the bond market, the corporate bond market. Okay? So where are they going to get the money in a slowing global economy to pay these debts? Where are they going to get it from? How are they going to do it? Because stock prices are predicated off of earnings. Well, the Federal Reserve is increasing interest rates. They are doing quantitative tightening for the time being. We're going to find out what happens next week because they have another FOMC, Federal Open Market Committee meeting, which is the body that determines interest rates and will set the path of future interest rate hikes or wait and see, or maybe even a decline. And of course, this is the same committee that will determine the path of the Federal Reserve's balance sheet in regards to whether or not they are going to continue with quantitative tightening, or if they will pause, or if they will go back to quantitative easing. Because this is all coming to a head. The piper always gets paid. Always. He wants his money, and he is going to get it. The problem is we're at the end of the business cycle, and we're in the midst of a global slowdown. There's no way around it. So where does the money come from, and how are they going to do it? Because you have to understand, these are corporate bonds. This isn't the stock market. This is the bond market. A bond is a contract. I give a corporation $10,000. They agree to pay me back my $10,000 at maturity plus coupons, interest, twice a year, once a year, whatever, for the duration. This is a contract. It's not a stock price where I'm taking the risk with the company that I am a shareholder, I am an owner of the corporation, and I will take part of the profits if there are profits. That's my risk. Bond market's different. That's a contract. I am loaning them money. That is a promise to pay. That's a contract, okay? It's a big difference. You have to understand this. So these corporations, in the worst case scenario, will have to sell off their assets to make the bondholders whole. So the shareholder would basically get screwed because he's not going to get anything. He's not going to get a dividend. He's not going to get share price appreciation. He's not going to get anything because in the worst case scenario, you have these companies. Well, worst case, I guess they go completely bankrupt, and then the bondholders would have to take a haircut, and they're not going to get back their entire principal, or they're not going to get their coupon payments. Any way you cut it, it's not good. All right. So when you look at this from a business perspective, you have a slowing market taking place. Okay. So one would reasonably assume that that means that their top line growth, their revenue growth, is going to decrease. At the same time, you do have some slight upward pressure on prices. We know wages are going up. We know they're not going up enough to combat the cost of living, but we know wages are going up. Okay? That's a cost of doing business. Your employees are a cost of doing business. All right? So in this environment where you're likely to get lower revenues, you have increasing costs that just tears into your profit margins. Okay? So if these companies are trying to maintain their profit margins to keep their stock price where it currently is or move it higher and have the necessary cash flow to pay off these bonds, something's going to have to give. If they want to maintain profit margin and if they want to be able to pay off these bonds, where are they going to look to save money? Well, you guessed it, one of the most expensive lines on the corporate income statement is employees, salaries and wages, benefits, all that stuff. So what does that mean? There's going to be some layoffs. There's going to be some layoffs. When's it going to happen? I don't know. I really don't know. We're in the land of Oz, but this is inevitable because this is what these companies are going to have to do. Now, President Trump just doesn't have it within him to tell these corporations don't lay people off. I mean, he can get up there and say, look, we have unemployment at 3.8%. That's the lowest it's been in decades. That's very true. But if you look at a graph, if you just look at, Google it. Just look at the unemployment graph. Hopefully you find a graph that has some shaded recessions on it. And any time that unemployment gets to basically its low for a period, and it hasn't been much lower than this, 3.8% in decades, a recession follows very soon after. Several months, maybe a year if you're lucky. But in the near term, you are more likely to see a recession than not. Because you're basically at full employment. Everybody's working. Now there's upward pressure on wages. Corporations are trying to maintain profit margins. And now you have everybody and their mother just awash in all of this debt thanks to all of this funny money that is now coming due. This is a storm that we have never seen before. We've never seen before. Now, you want to say, well, we have regulations in place. No, we have regulations in place against the last crisis. We don't have regulation in place for the next crisis. That's how it works. They never regulate the next crisis. It's almost an impossibility. But what you can do, if you really want to solve the problem, is you get rid of the income tax and you get rid of the Federal Reserve. That's how you start to solve the problem. Other than that, I don't take you seriously. Other than that, all you're doing is kicking the can further down the road. So we got a big problem here because you have these companies that have to pay off these bonds. Some of them, no question, are BBB. They are investment grade. But there's no question that in the time of economic distress, a lot of this is going to have to be downgraded because these ratings agencies are going to have to cover their behinds because they got taken to the cleaners in 08, 09 because they rubber stamped everything. They can't miss the ball twice. Otherwise, they're not going to be around next time, if there is a next time. So they are going to have to show some semblance that they are the adults in the room. And when you know what hits the fan, they are going to have to downgrade some of these companies from BBB investment grade to junk. And when that happens, there's going to be a huge sell-off of all of those funds that are not allowed to own junk bonds. And then after that, look out, because I don't know where the bottom in these bond prices will be and everything else that will cascade as a result. Because if they can't make their bond payments, how are they going to make their loan payments? How are they going to make their leveraged loan payments? How are they going to maintain profit margins and keep their share price at the price that it currently is? Now, if you can figure out that riddle, you're a hell of a lot smarter than me, and maybe you should be the President of the United States or the Chairman of the Federal Reserve and just say, look, no income tax, no Federal Reserve, and then you can be off to the races and starting to solve some of these problems after you have a huge amount of deleveraging, which must take place in order for this system to become cleansed. And then we can rebuild a new system. And again, no income tax, no Federal Reserve. You have either one of them, you're just shooting yourself in the foot. That's all we're doing. You got to take it seriously. You don't believe me? Look it up. You just have to think about it. You just have to think about how much more money would you have in your pocket if you did not have to pay income tax. And of course, I mean no payroll tax either for Social Security and no Medicare and Medicaid tax either. Look, we've made this mess. There's going to be pain. There's no ifs, ands, or buts about it. It's just a question of how much do you want to deal with, because the further along this goes, the worse it will become. You know, nobody wants to feel it, but do you want to push this out further and further, which is going to hit your children, your grandchildren, your great-grandchildren? I mean, when are you going to say, okay, I guess I'm going to have to take it? Even though maybe you've had nothing to do with it, you know, we have to have this conversation as a country, or the markets are going to do it for us, and I think that's more or less where we are now, because we have a president who was supposed to drain the swamp. Is he potentially in the process of doing that? Maybe, but we see the military industrial complex alive and well. We see the banks making record profits, and we have trillion-dollar deficits for the foreseeable future. So that's not much draining the swamp as I see it. Okay, are there some leaks? Are there some documents that are coming out now? Maybe some shenanigans behind the scenes. I talk about this on the geopolitical podcast, but is that enough? Come on. We need to see some real action here, because if there is a blow up in the economy, a lot of this other stuff isn't going to make a difference. So please, ladies and gentlemen, pay attention to this stuff. Don't be surprised if and when it happens, and prepare yourself. Do what you have to do. Talk to your financial advisors. Talk to whoever you have to talk to. But just prepare yourself for what is likely to happen, because this is trillions of dollars coming due over the next few years in an economic environment that is just slowing down globally. This is just common sense. It's just common sense. If they're going to continue to print funny money to somehow just wipe all this stuff away, well, then we're going to have runaway inflation. I mean, the dollars in your pocket are going to be completely worthless. So much for helping the lower income families in the middle class of this country. I mean, gone. Your purchasing power is completely shot. So I mean, where's the leadership? Where's the leadership? Get the word out. Tell people about this podcast. Get the word out. Get the truth out. Help as many people as you can. Ladies and gentlemen, it's been a pleasure having you as always. This is St. Patrick's Day weekend. So if you go out and celebrate and you're drinking, please don't drink and drive. Get an Uber, get a taxi. Be smart, use your head. No fighting, none of that stuff. Enjoy it. So enjoy your weekend. Please like, share, subscribe, get the word out, leave your comments. I would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.